Hello?
Yeah, I can hear you. I'm just
Yeah,
trying.
the first thing to check there is to check the cost. I mean, when you say the cost, it's not the, let's say, the balance that they use to calculate all this thing. It's a lot of calculation. So, but I believe
Yes.
that by checking the balance in PPE
Mhm.
against how this thing is being calculated, the the rate, I mean the depreciation rate.
There is something that you are supposed to, there is something that I want you to mention that could have, that is
Okay.
most likely 70 to 80% likely that that is the reason why this thing is like that. And that thing, you have already
Okay.
mentioned it, that you are going to locate it in the asset, which is the PPE, right? You are checking the PPE
Yeah.
account. But there is something that must have happened in the PPE account. In my opinion, there is something that must have happened in the PPE account. What do you think could have happened?
Maybe, maybe you could let us know then. Because
Ah,
that's
okay.
the
I mean.
uh,
So this is it. Disposal. Disposal. They will have taken
exactly.
disposal. I want you to mention that
Exactly.
because for depreciation to come
Okay.
down, disposal one way or the other must have happened. Do you
Have
agree with me, sir?
happened. Yeah, yeah, you are right. You are right. It's
Dispose
part of the, yeah, it's
exactly,
part of eh,
exactly.
that was
So
what I mentioned. That what I told you in that in that
sales zone,
in cell loan that there might be
a lot of
addition.
things.
You said
Yeah.
no. You said
Mm-hmm.
no.
Mm-hmm.
That's why I did not mention disposal here.
So the thing is, this thing, right? The way I want us to look at it, COVID is happening. In Shell came and say, meanwhile, there might be an added advantage for me because I've actually done a report on this thing for us, right? So I've actually dig deep. I've done the reports, right? So the report is ready in terms of ratios that we will all still, discuss together. There is a
Okay.
report. But where I want us to look at is that some of these things, yeah, if you see that, okay, during COVID, there are high chances that there will be no new acquisition. And they have already said that depreciation, depletion, and amortization. And we all know that there is impairment that will happen as a result of COVID. Because COVID time is an indication of impairment, according to IAS 36, one way or the other, right? Then the next thing is that if you are now seeing a company that is doing other way around, what could likely make that possible? That depreciation reduces during the period. Because worst case scenario, you're supposed to grow because of a number of assets, not especially because of the industries these guys are playing. Revaluation deficits could have happened to a number of assets because people are scared. Nobody knows when depreciation is going to. Please mute your mic. Meshach, please mute your mic.
Oh, sorry.
Thank you. Nobody knows when the COVID-19 thing we stop. Everybody we were all scared. And because of that, for Chevron, some disposals actually happened. And I'm going to show us. But before I continue to dabble around just individual trend, let's now do ratio analysis. Let's analyze the ratios. So everybody, we can lower our hands, please, because I want to ask another question so that it can be very interactive. I've already prepared the report. So trust me, for me, I've already derived some of the things that I want to derive. And guess what? I've prepared this report sometimes 2021. Yeah, 2022. That's when I prepared this report. And two things here. If you are still a student, please pay serious attention to how I have done this ratio analysis. If you are still a student, because it can help you one way or the other. Most especially if you are a student writing ICANN or ACCA or other professional exams, and you probably be getting to do some of these financial analysis or financial ratio analysis now, right? Pay attention. And if you are somebody that is working, this will also benefit you because you are going to we are going to be able to explain to ourselves how some of these numbers interact, how they interact with each other, like how all of them comes to be in the first place. So let's pay good attention here, because we are going to be doing ratio analysis, and that is like where we are going to be stopping today's class. Let's quickly, in 20 minutes or less, let's quickly get the ratios done so that we can now have a lot of questions. The questions will help us to take the point home. I really believe so. So now, this is Shell's financials. Shell is the main company. For those of us who wants to consider investment decision, you are looking at the company, you want to consider whether to invest in it or not. What are the things you should look out for? In today's world, July, was it July 2023 or last year? Hold on, guys. I've not even asked my question. July 2023, in today's world, if you're looking at the company's financials, ISB introduced IFRS S1 and S2, right? To tell us about sustainability. So in today's world, sustainability is becoming a big deal. And guess what? Before IASB comes about this, or came about this IFRS, right? Shells, chevrons, and the likes, they are already responsible for going about ESG reporting. Even myself, I took a course on ESG as far back as 2022. I already took a course on ESG reporting as far back as 2022. Because it is increasingly becoming a talk of the town, and it is becoming a serious investment decision making metric. So as much as possible, before you start investing in a business, try, because we are, should I say, low-end investors. If you are buying shares and you are buying this, the high-end investors, those institutional investors that make the key decisions, they are considering these things. And those ones, if they happen to withdraw their investment from some of these companies that we are talking about, we should know that our own money might not even survive. So we also have to pay serious attention to all of these things. Please, if you have any question, let's just keep it to question and answer period. You can write them down. Let me just be the one asking the question and doing the presentation for now. I ask question, I do my presentation. So ESG is a thing. You have to look out for it. Most especially when we are talking about publicly quoted companies. Look out for their ESG reporting. What are they saying about sustainability? What are they saying about corporate governance? What are they saying about sustainability reporting in terms of even succession planning? What are they talking about? All of these things. What is their management team looking like in terms of the corporate governance aspect? We know that in corporate governance, there is also that gender equality and all of these things there. But before we now come to all these financial metrics, like what? The financial ratios. Now we are at financial ratios. You want to assess a company. We have 5 different classes of ratios. Or is it more than that? Okay, I think let me just list them. I think there should be 5. We have the profitability, we have the liquidity, we have the efficiency, we have the leverage, and then we have the market ratios. I mean, if there are other ones that I must have missed, somebody else can help me type it in the chat box. But those are the ones I can remember right now. Now, guys, I need people to tell me. You are seeing 5 classes of ratios. At least help me mention one across at least 2 classes of ratio that you want to invest in Shell. And not just that you want to invest in Shell. In fact, you want to invest in Shell. Let's put it that way. Or you are writing a report on Shell's financials. You want to tell us the financial health and well-being of Shell. What are the financial ratios that you are going to consider? Okay. Osaro, please give it a shot. Mention 2.
Okay, sir. I will look at the liquidity ratio, because the liquidity ratio shows if the firm can be able to meet their short-term obligation. So I will look at the
Which of the
liquidity ratio.
ratio? Which of the liquidity ratio are you looking at?
The the current ratio.
The current ratio.
Uh,
Thank you.
uh, okay.
Okay. One more. One more. Osaro, give us one more. What other ratio?
Okay. Profitability ratio.
Okay, which of the profitability ratio are you looking at?
Uh, can't really think of any now.
Okay, that's fine. Thank you very much, Osaro. At least you gave us current assets and you told us why. And it is very important during COVID period because a lot of businesses shut down during COVID
I'll look
period.
for liquidity ratio because
Okay, go ahead, please. I've not called you, but go ahead. Okay, this is not here again. A lot of businesses actually shut down during COVID period. A whole lot of businesses. And why? Because of the catastrophe that COVID brought. And because of that, we need to be sure whether or not a company will be able to meet their short-term obligations. Even in today's world, most especially for those of us that are working with startups, these are key ratios that we need to be monitoring for some of these startups. Liquidity ratio, and that's current ratio. Thank you very much for that, Osaro. Folashade, please give it a shot. A lot of people have mentioned a lot. I'll come back.
good evening, everyone. Thank you. Sure.
Go ahead.
Okay, I'll look at the gearing, the retention ratio, and possibly the earnings per share.
Come again.
The gearing
What
ratio.
is there? And why are you looking at it?
I didn't get that.
What ratio is gearing ratio?
That's the total debt over their total equity.
There are types of gearing ratio.
Yes,
There is
the
debt
ratio. The
and there
gearing
is
is
another one. Okay, you are looking at debt to equity, yeah?
yes.
Why are you looking at it?
To show how much the company is owing and in line with the ability to pay. So it also determines their going concern. So
Is that correct? Is that correct? Is that true?
it shows how much a company owes in relation to their retention.
Okay. But really, okay. Fine. Any other one that you want to say?
Then the earnings per share as an investor.
EPS
Yes.
as an investor. Thank you very much for that. Thanks. EPS is actually very important to you as EPS is actually very important to you as an investor because it is ultimately what is going to get to you in the immediate, as dividend or whatever the case may be. Mr. Babatunde, then followed by Adeniji Victor. Please give us two. Which and which?
No, actually, my own, what I want here, I know the dividend per share is okay. You understand me? That is supposed to do. And then EPS is also fine, which is any per share. But because of the COVID, to me, if I want to do any investment there, I will go to the note to be able, because all what they have, their parameter for that year might not be might not be realistic.
No, I
Because
wouldn't
of
say
the
realistic because they are not forecasting. That thing has happened.
it has happened. All what happened there, you understand me? I didn't see it as a parameter to measure the efficiency or the productivity of any company. If I
That is
would do it,
okay. Go ahead, sir. Go ahead.
if I would do it, I'll go back. I'll look what they've done before COVID
And
to
but
judge it.
COVID is the new normal.
I'm,
COVID is
no,
the
I'm
new
co-
normal.
no, no, I'm coming to this thing. I
Okay.
will go to old normal, which is old normal before COVID, and then if there's anything after COVID, I'll now use that one to judge them. And then most of the things that will happen will be in the note, will be in the notes, and then it will be in the director's report because
That's
of the plan that they, because their plan that they have after the COVID will determine how profitable that company will be. And then from there, I will pitch it with their I will pitch it to the industrial performance to know
thank
maybe if they can be
you.
able to do it.
Thank
Thank
you.
you so
That's
much.
exactly where I was waiting for you to get to. Thank you very much for that, sir. Thanks a lot. I mean, that is exactly because you know what I wanted to say next. I wanted to put a constraint to say, what if you must make that investment decision that year? What do you do? That is where you went to eventually. Benchmarking. That is where benchmarking comes in. You have to look at the industry standard and look at how well they have performed against other competitors or other players within the market. That is where benchmarking comes to play. And we actually did that in this particular session that we are actually going to touch base on that, because some people have not even mentioned profitability ratios that I want to hear, but it's fine. If I go ahead. Sorry, Victor, before Ifeanyi. Victor, please go ahead. Sorry, Victor,
Oh,
before.
okay, okay.
Thank you, Victor.
I was my first one I wanted to mention before was I think after I determine how long I want my investment to be in that particular organization, which is what I first have to decide as an investor. So after checking their liquidity ratio, I think the most important thing is also check their profitability. You have to be sure. You have to check their profitability ratio. You have to be sure
Which of the
how
ratios under
the organization
profitability are you checking? Which of the ratios? Mention one. Which of the
on
ratios under profitability are you checking?
their net profit margin.
Net profit margin.
Checking
Okay,
their
interesting. Interesting. That makes why are you checking net profit margin? Let's see.
because I want to check how much revenue, the comparison of their revenue to their net profit. Just
Hmm.
simply because I want to know how much how much their revenue actually amounts for the profit they are making. Is it that they are making much revenue or they're actually um, spending less? That's my own decision. So I want to check their net profit against
That's
their
fair.
revenue. That's
That's fair. That's fair. Thank you very much, Victor. That's fair. Ifeanyi.
Okay. Yeah, in addition to the net profit or gross profit margin, you can also look at the return on
Yeah.
shareholders' equity to determine how much of the profits the company is making that would be attributable to the shareholder shares that was brought in by the shareholders. And we can also look at the return on capital employed as well.
Okay, thank you very much. You have mentioned to. Okay, let me call Adebanjo Adetuo. So after Adebanjo, this is already 6:30. We review
Okay.
the ratios that I've done, and then from there we look at things together. Yes, Adebanjo.
Yes, thank you. My apology for the first time that when you mentioned my name, I was just
No
joining.
problem.
And
No
for
problem.
me, I will look at this liquidity ratio, whereby I will consider the working capital.
Okay, interesting.
And under the profitability ratio, I will consider the return on capital employed.
Okay,
That
thank you
is
very much. Thank
that
you.
is for
I
me.
mean, why is nobody mentioning efficiency during COVID period? People are not mentioning efficiency, and it was COVID period. If there is anything that will speak to how well a company performs during that kind of period, it's supposed to be efficiency. How efficient was the company during the period? What are the key? And I love what Mr. Babatunde mentioned about going to the director's report to know what exactly do they say. What are the plans that they have for the future? What are the efficiency looking like? Thank you very much, guys. I mean, it's really a pleasure. So let's quickly run through what I've been able to come up with for us, because it excludes expenses that may be volatile. Okay. Personally, I will look at solvency. Yeah, somebody has looked at solvency before. Let me read out some of the chat box. Personally, I will look at solvency ratio, specifically debt to asset ratio and debt to equity ratio. I wouldn't want to invest in a company that will fold up soon. Fair enough, fair enough, fair enough. Okon Queen. Also, Mosumola Ali, EBITDA margin, easier to compare other companies because, okay, return on investment from Great Johnson return on equity, Tayo Lola return on investment as well, Sikru Azan gross profit margins, net profit margins, quick and liquidity and current ratio, also long-term solvency, and which one is COGS ratio? Sikru Azan, come and explain yourself. Which one is COGS ratios? Cost of goods ratios. Is there anything like COGS ratio?
No, what I mean is the turnovers, like cost of goods sold all over revenue.
Is that now COGS ratio? Okay. I mean, you are looking at the efficiency.
Yeah, I'm talking about even turnover.
Oh, but it's not
Yes,
COGS ratio.
efficiency.
Must
It's
it be
inventory
inventory?
turnover.
Before you get COGS, must it be inventory? Is it only inventory that enter COGS?
That's the part I'm looking at.
Well, don't use the wrong terminology because it is not only inventory that enter COGS. I ask you, for example, if we are using this, if this class is a paid session and they are admitting people in per we are charging 5,000 naira per people, and we are going to pay Google Meet. Out of that 5,000 naira, we are going to pay Google Meet 1,000 naira per person. What is our COGS?
Sorry, can you repeat? Can you repeat what you said?
This class is a paid session. This class is a paid class. We charge everybody on this call 5,000 naira per person.
Okay.
And for everybody to be admitted, Google Meet is going to charge us 1,000 naira per person. What is our COGS?
That's the 1,000. That's the 1,000 you're paying to.
Well, is that 1,000 naira an inventory?
I can't say it's inventory, but it's cost of you selling
it's inventory
it.
now. Say it's inventory. You can't say it's inventory. I don't understand. Something that is clear. You say you can't say it's inventory. Is it inventory? Hey, God have mercy. Please, let's just move on. You can't say it's inventory. Is it inventory? Please, bro. Let's move on. Thank you very much. I mean, that was a nice conversation. You can't say it's inventory, Bao. So, point of correction, everybody. COGS doesn't necessarily mean that it has to be inventory. COGS doesn't necessarily have to be inventory. As long as you have a direct cost that is unitary in nature, that is associated to the selling, then you can have your COGS. It doesn't necessarily have to be inventory. And then somebody said something about saying the other time that depreciation as part of your inventory. Don't do that. Don't ever find your way to add depreciation or amortization to inventory, no matter the business idea, no matter the business structure. Depreciation and amortization to inventory or to COGS, that's going to be very, very wrong. Very, very wrong. And the reason is not far-fetched because you cannot base them on a unitary term. I mean, this is a financial statement analysis. You're supposed to talk about it, but don't let me dwell too much on that. Let's move on to what we have here. So what do we have here? Many of us have said something about the ratios that we want to calculate. We have said a lot of things about the ratios that we want to calculate. And then I've done a note for us briefly here. And from the notes, I'm going to be showing us how exactly, as professionals, as students, how we should be going about our ratios calculations or ratios interpretation. We all know how to calculate ratios now. Who can tell me the formula for net profit ratio? Anybody? Formula for net profit ratio? Daniel, please give it a shot. Daniel and Yaji. Okay, Blessing, you can help us. Is Blessing there?
Okay. formula for net profit ratio, revenue
Yes.
minus cost.
No, no, that's not correct.
Net profit divided by sales revenue.
Thank you. Net profit divided by revenue. Thank you very much, Damilola John. Thanks a lot. So I've done that for Shell and Chevron. I've done that for Shell and Chevron. And somebody, we can also do it by ourselves, looking at this. So if you look at it, I've done it for Shell and Chevron. And now that I've done it, let me now tell us, I'll do two things. I'll tell us the number, and I want, okay, we might not be able to do what exactly I want to ask. Let me see how to make this session interactive. Okay, I'll still try. I'll ask questions. I've done that. So I say here that we have evaluated Shell's performance using the following ratios. We have considered both financial and non-financial performance metrics. And then our findings review the following. Profitability ratios. Ratios under these metrics basically measure how profit-making a company is. That is profitability ratio. They evaluate the ability of a company to generate income and how well a company utilizes its resources to achieve profit from its operations. The difference, please mute your mic, please. The difference between, Kazim, please mute your mic. Guys, let's mute our mic because at least I need like 10 minutes to quickly run through this. Then we'll ask questions. The difference between net profit ratios and gross profit ratio. Who can tell me the difference between net profit ratio and gross profit ratio? In one sentence, no long sentence. One sentence. What is the difference between gross profit ratio and net profit ratio? Ali from Layo.
Okay. Net profit ratio is when other expenses have been deducted from the revenue.
You only mention one now. Ayaji, please go ahead.
Okay, so net profit ratio factors in the expense, like expense have been charged to the gross profit against the gross profit rather to get the net profit. So it is just the expense part, like the operating expenses, expense part that makes it different.
Operating expenses part. I mean, let me rephrase my question for people who are working. For people who are working, let me ask this question. Please, everybody, let's lower our hands because I want to ask question from our experienced hire. People who are working, who can easily look at a business and without running numbers can tell us whether or not the business we can invest in it. You are seeing a business, and then the gross margin is at 20%. Are you likely to invest in the business? Why and why not? Who wants to give it a shot? 20% gross margin ratio. Why and why not? Dapo, please give it a shot.
Yeah, good evening, everyone.
Give it a shot.
When we have a gross margin that is like 20%, it shows that the company is not earning enough to be able to cover up for its operating expenses, because by the time they charge the operating expenses, the remaining amount that will be left will not be sufficient, and it might even run into loss. So it's not enough. Like
So
20% is not enough at the gross margin.
It literally tells you that as soon as you see a company that gross margin is saying 20%, it tells you that the direct cost to even run that business is already very high. Not to now factor in the OPEX. So what do you do during that period? What do you advise? You probably advise them to look at the direct cost again and look out for area of optimization for the direct cost. Area of optimization for the direct cost. 80% COGS is just too much. Exactly. It is too much. Mr. Babatunde, you have your hands up. Let me hear from you before I move on. Okay, I think it's not for this particular one. Moving on. Yeah. Can you guys hear me? Please say yes.
Yes, sir. We can. Yes, sir.
Okay.
Yes,
Hello.
you can.
Hello.
Okay. Go
Hello.
ahead. Yeah, we can hear you now.
Yeah, it's just my opinion about this gross profit margin. Actually, what you said is correct, But some company that are using it as a way to do
Evasion,
tax avoidance
tax avoidance. Yeah.
by trying to use, by trying to use direct cost. When you want to get your what they will charge at sometimes tax people will not look at your direct cost
Mm.
because they believe that it's related to your product, and then they put eyes on your OPEX. Some people normally use it. They make all those direct costs to be high in order to do the tax avoidance. So
But
sometimes when you see it like that,
mm-hmm.
optimization might work if it is optimization might work, what you said, but it depends on the focus of the company. Like me,
But
I work with a
mm-hmm.
company that because of the tax, we normally all our costs are supposed to be part of OPEX. We do it as a direct proportion to the job that we do, and then we do what they call job costing. And then when you
Mm-hmm.
do job costing, most of the job costing expenses always be in direct cost. At the end of
Mm-hmm.
the day, our OPEX will be very very light, but
Mm.
our direct expenses will be very very heavy.
Mm.
So
Fair enough. Fair enough. Fair enough. Fair enough. And
so
that
that's
means
the way we.
I love this conversation because this shows the level of how much people actually understand this subject matter. Because I mean, if people are already doing job costing to ensure that they load their cogs very well, that means that kind of company will probably not be seeking investors. They will not be seeking investors, and they probably will not be startup as much because investors and as a startup, one of the primary metrics that an investor will seek out from you, even as a startup or even as an established, is to first look at your gross margin, because gross margin is a key. So the person that is asking, what should you look out for in a business? Look at their gross profit margin. Gross profit margin is a very, very key determinant to whether or not a company will succeed. So if it is already very high, and if it is being done now, let me now make it clear, because I mean it could be a practice for financial management purpose. Now we have to consider IFRS and IAS. The practice, is it now in line with IAS and IFRS? So we have to look at that, because job costing is a technique in what? In management accounting. Job costing is a technique in management accounting. So by the time you come to IAS and IFRS, will it be justifiable? So if it is justifiable, fine. Then that means that makes sense. Perfect sense. But if you look at it very well and we bring fork and knife and we start dissecting it and it is not justifiable, then we know that no, we are not going anywhere with this. Mr. Vatunde, what do you think? Is it
uh,
justifiable based on IFRS and
yeah,
IAS?
yeah. Actually, what we do is justifiable under under any statutory reason that you want to look at. Because if it's not justifiable, even the tax people will not take it. You understand me?
I mean, don't let us use the tax people now, because I mean,
No,
if you
no,
bring,
no. I'm just no.
I understand you.
No,
I understand you.
I started from that angle.
Angle.
That is
Yes.
why I'm just.
Okay.
We are not doing. We are not doing tax evasion. We are just looking for the loopholes that we can easily do. No, I'm just telling you that sometimes
Okay.
some
Do you
companies.
use
No,
salary? If you bring it
no.
to me, if
No,
you
the
add salary
salary.
into it, if you
No,
bring it to me,
yes, we have
I can
salary.
I can find a way. If you bring it to me and you explain what you are doing, I can easily tell you. I can debunk it if it will fly or not.
Don't worry about that. The only thing is that
I love
the only thing is that
makes
what you
sense.
have been doing for more than is working because of the nature of our job. The
Exactly.
job that we are doing, the nature of the job determines a lot of things. This is a job
Exactly.
that will cost today, tomorrow it will increase maybe by 10 or 20%. Even this thing will not help us even to be able to fight inflation and all these things, so that what you are going to give at the end of the day, as our revenue will not go up, will not go down, because you've already factored in everything. But most of these costs, they fall under direct cost.
I'll ask one simple question, sir. Is your company a
Yeah.
service-based company or a product-based company?
No, we are into two. We are serving. We are into both.
It will be very difficult to, my Oga.
No, we are doing it. We are doing it, and then
I
the
mean,
thing is
but
working.
I think that
No,
makes
but
sense. Don't let it become.
sir,
Yes,
sir,
please, guys.
sir, what you said for the investor, that's what they look for. Our own investor, we don't look for investor like investor
Yeah,
like everybody. We
yeah.
look for
That.
we do what they call cherry pick. Cherry pick, those people that understand our business. And then
Uh-huh.
as we talk, we sit down around the table. And even what I'm saying now is one of the enticement that we normally give to explain how we are doing it, and then because a lot of things is involved. It's not that we are looking for all this investor everywhere. But meanwhile, explain everything to them. They will see what we are making, and then they will see what we are paying tax. And they will not ask us, how are you doing it? Are you people doing what they call tax evasion? By the time we explain everything to them, show them the actual of what they are doing, we want to say, hey, you people are financial engineer. So you understand what I mean?
I mean, that's the only thing that could probably be possible. And I agree with you. Somebody also said it is possible that you have a gross margin of 20% because there are some companies in the downstream and all of those things. Those things are quite possible too, depending on the industries or the business nature of the.
Even this man, fast moving consumer goods, their distance is between 20 to 25.
Yes. Yeah. So now, I mean, I love that we are having this conversation, because it now tells you that. That's why I asked that question: is it a product-based business or a service-based business? So if it's a product-based business, you can expect, depending on the product-based business, like somebody said, downstream, or some oil and gas, or some FMCG. But even at FMCG level, by the time we go to the unit economics of the everything that they are doing, we go into the unit economics. If the numbers are not making sense, they are not making sense. So we are not investing, right? If the numbers are not making sense, they are not making sense. 20%, very low, or maybe reasonable for some industries. And that is why financial ratios are not usually cast in stone. And that is why you are not going to use just one single metric to make your decision. And let me quickly take us through. I mean, we have less than 10 minutes to go. Taking us through this guy, look at what we've done here. We said Shell witnessed, and this is how to run financial ratio analysis. Look at the way I approached this guy. And there are two things that is going to be happening here. I'm going to be doing trend, and I'm going to be doing benchmarking. I said Shell witnessed a negative net profit ratio of 12% in 2020 compared to 5% reported in 2019, right? This can be attributed to the unprecedented COVID-19 pandemic outbreak in 2020, which wreaked global economic havoc and made the US oil price briefly turned negative for the first time in history. See, the mistake that many students used to do, even students that are writing case study, by the time they write this first line, some of them will stop and say they are done. You are not done. That is not how to run commentary. How do you run commentary? You run commentary by first saying the result. What is the result? What is the cause of the results? What is the impact? And do you have any recommendation? Or what are the conclusions? What are the judgments you are able to make? This is the result. We have seen that, yes, net profits turned negative to 12% in 2020. But why? What caused it to turn negative? Now, to know that what caused it to turn negative, what you now need to do is to go and look out for the composition of what makes up the net profit ratio. And that is one of the reasons why I first asked us to define net profit ratio. you look out for the composition of what makes up net profit ratio. So what makes up net profit ratio? What? We know that it's net profit and revenue. So whatever we are going to be saying now, we are going to be attributing it one way or the other to how the events during the period affected the net profit and revenue. We now say this can be attributed to the unprecedented COVID-19. Meanwhile, if you go and check, hold on, give me a sec, people. I need to plug my system. Yeah, done. So meanwhile, if you go and check this thing, unprecedented. See, if you go and check Shell's report, you see it there. They also mention it. You see, they are already mentioning COVID. COVID was highly mentioned about the fact that, see, this is it. So they mentioned the fact that the unprecedented COVID-19, it's caused a lot of, it wreaked havoc that affected the US oil price, and it turned negative for the first time in history. In addition, the pandemic drastically suppressed energy demand, and that's why I said the first person that responded was right. Suppressed energy demand during the year and caused Shell's revenue to drop by 48% from 334.9 billion in 2019 to 180.5 billion in 2020. Guys, can you see the way I'm explaining the ratio such that anybody, any senior management or exec is reading this, they are going to be nodding their head that no, this guy knows what he's doing. He knows what he's saying. And this boils down to understanding what has happened, understanding the transaction. Conclusively, Shell's net profit significantly dropped by 231% from 16.4 billion in 2019 to a net loss of 21.5 billion in 2020. I use significantly because it is so significant. We are talking in billions here. Somebody was making 16 billion net profit, and all of a sudden going to 21.5 loss in billion. That's significant. The significant drop in net profit is attributable to a spike in its depreciation, depletion, and amortization for the year, which grew by 38% from 28.7 billion in 2019 to 52.4 billion in 2020. Can we see? This is how you let those numbers interact. Here alone, I have used revenue, I have used depreciation, I have used net profit in this conversation alone. Moving on, we now say Shell's performance in 2020, when compared with Chevron, revealed that the management of Shell was able to efficiently contain the effect of the pandemic on its overall profitability than Chevron. Why didn't I say on its revenue than Chevron? Who wants to answer? Why didn't I say on its revenue than Chevron? Anybody? Why didn't I say on its revenue that the management was able to contain the effect of the revenue on its of the pandemic on its revenue than Chevron? Why didn't I say that? Who wants to try? Who was there when we first look at the statement? Let me show us the statement again. This is Chevron, and this is, oh no, I've moved away from the Shell. Yeah, I'm coming. 190 something. This is Shell. So this is Shell, this is Chevron. Why didn't I say that it was able, the management was able to contain the effect of the pandemic on their revenue, and I said on its overall profitability? Why? Anybody? This is Shell annual report. This is Chevron. If I let me call Chinedu, please go ahead. If I is not ready. Chinedu, are you there? If you are ready, you can go ahead. Let's make it very fast now. I don't have much time, please.
Okay, I don't know really, but I mean,
You
you
need
said
to
give me
know
the
now.
shot,
These
so
are the
why not?
numbers. We are looking at the numbers. You can't say you don't know. No,
Okay,
you can't
I
say
think it's
don't
because
think. Don't
okay,
think.
okay, okay.
Don't think.
I know,
Give me the exact.
I know.
Eh,
Okay, I'm saying that it's yeah, you are not saying that the management did better with the revenues. You are not pointing out the revenues directly because the global plummet in oil prices both led to the reduction in the revenue of both firms. So both firms actually
That's
had a
not it.
reduction in revenue. So I think
That's not it.
okay, okay.
I think Mr. Babatunde has mentioned it before. He observed it before, and we did not pay. We forgot. He observed it before, and if you look at it as well, you also observe it. Look at Chevron, 139 to 94. Look at Shell, 344 to 180. Can we see it now? Chinedu, can you see that?
Yes, I can see that. I can see.
So what does that tell you? Efficiency wise, what does it tell us?
Sorry, I
Anybody?
didn't get you. What did you say?
Efficiency wise, what does that tell you? What does that tell you about Shell and Chevron performance in respect to revenue? Who wants to try? What is it telling us? What is this? What are these numbers telling us? If I don't have much time, pa. If I you, Folashade, please give it a shot.
Okay, so the level at which the revenue of is it Shell now deepened compared to the other company is not as huge.
I want somebody that can hit the nail on the head. Folashade, don't worry again. Okay. Adebanjo. It's just a very simple sentence now.
Okay, my observation is this. If you look at it, the performance of is it Chevron now?
This is Chevron.
Okay, the performance of a share is in terms of performance. Shell is more proactive than the.
No. That's not it. That's not it. Thank you very much. That's not it. I mean, my people, it is quite visible now, and somebody has said it before too. He has said it before that Shell's revenue dropped a lot more than Chevron, and as such, in terms of revenue, Chevron was more efficient compared to Shell. In terms of revenue management, Chevron in this case was more efficient compared to Shell, and that is why I did not mention revenue here, even though revenue is an element in both in calculating net profit margin. I did not mention revenue. I mentioned what? Overall profitability, because that one shows that efficiency. That is what net profit ratio is all about. That's not exactly what you are saying now. Why Chevron revenue dropped by 32% from 139 in 2019 to 94.5 billion in 2020 compared to a 48% drop in revenue of Shell? Chevron's overall net profit ratio dropped significantly by 400% in 2020, from 2% net profit ratio in 2019 to negative 6%, while Shell's net profit ratio dropped by 340%. And this is it. You have been able to compare both of them. But can you make decision based on just this one? No. You still have to go further. And going further, we pick the return on capital employed of both companies. We say, based on the return on capital employed of both companies, rose for Shell stood at -7%, as against a positive rose of 9% in 2019. The aforementioned result shows that Shell's investor gained 9 cents on every dollar invested in 2019, but lost 7 cents in 2020. This is primarily due to the negative impact of the COVID-19 pandemic, which reduced the company's earnings before interest and tax by 176%. Because earnings before interest and tax is a composition for calculating ROCE, return on capital employed. I hope we are learning one or two from this conversation. This is why I don't
Yes,
like
sir.
teaching.
Yeah.
I don't like all these notes thing because they are usually sometimes they just get boring. But I hope it is not too boring, right? Then moving on, we say this is furthermore the company's decommissioning and other provisions increased by 29% from 2.8 billion in 2019 to 3.6 billion in 2020. Both factors contributed significantly to the poor return on capital employed result in 2020. Chevron reported a negative ROCE of 3% in 2020 compared to Shell's minus 7%. Though Shell investors appear to have lost, and this is why I'm correcting Lillian the other time. As soon as I said though, you people already have something that you are going to be thinking. Though Shell investors appears to have lost an additional 4 cents on their investment when compared to Chevron's investor, the overall result of both companies' ROCE revealed that Shell was better able to manage the effect of the pandemic on its capital employed than Chevron. While Chevron's ROCE fell by 210% from a positive ROCE of 3% in 2019 to a negative of 3% in 2020, Shell's ROCE fell by 181%. You see the way I'm comparing them? Though individually, if you are looking at Chevron only, you think Chevron is doing better than Shell. And if you're looking at one perspective, you think Chevron is doing better than Shell. But eventually, if you look at all the perspectives together, you see that Shell is doing better. That's what this story is telling us. Here, it was saying that Chevron reported a ROCE of 3% in 2020, while compared to Shell's minus 7%. Minus 3% compared to minus 7%. Which one is worst? Minus 7% is worse, right? However, by the time we go into deep to look at prior year performance of each company and then compare them on how they have actually performed during this year, we are able to tell that efficiency-wise, Shell was better than Chevron during the period. And that's what this guy told us. In comparison to Chevron, Shell was able to reduce and contain its selling and other administrative expenses during the year. And by the time you go and look at the selling and other administrative expenses during the year, this is Shell. Selling and other administrative from 10.4 billion is reduced to 9.8 billion. You can easily say, yes, that is very possible because of COVID. There was not too much activity. Come and look at Chevron. Selling and other administrative expense, it increased 4.143 to 4.213. It increased. During COVID, your selling and general administrative expenses are still increasing. Why? Efficiency. I hope I'm making sense, my people. And I hope it's not getting boring, because if I'm talking for too long, I'm hoping it's not getting boring. So moving on here, we have been able to ascertain that Shell was able to better manage and contain their selling and administrative expenses compared to Chevron during the period. But does that mean that ultimately Shell performed better than Chevron during the period? We can't tell yet, because there is still those efficiency and other ratios that we need to take a look at. I mean, I might not be able to run through everything one by one, but we are almost done. I will just stop at, let me see, the inventory turnover. From the inventory turnover point of view, Shell reported an inventory turnover ratio. I mean, what is inventory turnover ratio? For those of us that doesn't know, this ratio measures the ability of a company to manage its inventory optimally to generate revenue. That is, it gives information about the rate of sales, how quick you are selling. That's just basically it in layman terms, how quick you are selling. Then the next thing, Shell reported an inventory turnover ratio of 6 times in 2020, which is 43% lower than 10.5 times reported in 2019. Shell appears to have struggled to sell its inventory stock faster on average during the year 2020. And the reason for this is not far-fetched, as the pandemic suppressed energy demand. Can you see? The reason for this is not, I mean, the result is there, but we know the reason. And that is why you as a professional, if you are used to sending monthly management reports to your company every month, and things are doing the way they are, and you're not even giving them any commentary, you are not doing yourself good. Not to talk of your management. You are not doing yourself good enough, because you are not practicing some of the things that you have learned, and you're not going to be able to know more about the business. Revenue drop. You don't even know why. You are just reporting it. number cruncher accountant. You can't be like that. You have to be a financial analyst. Revenue has dropped. You have to call the sales guy and ask them, why do you think revenue has dropped? What happened? I mean, that is how you are going to be able to have impact and make significant impact in your organization. But if the revenue drop, you don't know. Expenses drop, you don't know. You are just reporting number. You are just preparing GL. You are just preparing schedule. You are just reconciling. You don't even know anything that's going on with operations. You don't even know how the numbers comes to be in the first place. That's not good enough. It is not good enough. You have to get involved in the operational side of things, business operational side of things, regardless of your position in the organization. You have to get involved as long as you are seeing the numbers. As soon as you are seeing the numbers, you are able to ask questions. Call the right people, ask them questions. So aside from the pandemic, Shell's performance was hampered by competition from renewable in the power sector. Yes, there was pandemic, but we also read that there was significant increase in competition in the renewable sector. So which means that it will affect inventory, it will affect sales. When compared to Chevron, Shell management appears to have been unable to efficiently manage Shell's management appears to have been unable to efficiently sell its inventory faster, as Chevron reported an average of 11.3 times inventory turnover ratio in both 2020 and 2019, which means Chevron performed better. Chevron was still selling. This tells us so far that on the surface of things, Shell is bigger than Chevron. If you go outside and want to go and do any form of argument, you don't need to argue. Just look at the numbers. From the numbers, it is very, very clear that Shell is bigger than Chevron. I mean, we've looked at how Shell and Chevron were, Shell is doing well here. Imagine that Shell's revenue fell by that much. It is still more than that of Chevron, right? Now, I need to wrap up now. When compared to, we're already 9 minutes behind schedule. I'm so sorry, but yeah, when compared to Chevron, Shell management appears to have been unable to efficiently sell its inventory faster, as Chevron reported 11.3 times inventory turnover ratio in both 2020 and 2019, despite a 35% decrease in inventory turnover from 13.7 times in 2019 to 8.9 times in 2020. Chevron appears to be 18% more efficient than Shell. I still mention it. This is the percentage that they were able to use to be better than Shell. This is a deep level of financial ratio analysis, and you must be able to know how to carry it out. And how do you know how to carry it out? By understanding the composition of the ratio you are calculating, and then by understanding what costs, what the ratio, the numbers that you are reporting, what is the cost behind those numbers. When you understand those two things or those three things, you are able to support any form of business, regardless of how large they are. I've never worked in a PLC before, but I'm still able to come up with this. Why? Because I understood, or I've been able to understood how all of these things, how they come to play. So moving on, we now said Chevron appears to be 18%. Chevron's ability to better manage its inventory turnover ratio can be attributed to its investment in selling general and administrative expenses incurred in 2020. So that thing that we said was bad, we said it was bad that Shell was able to manage the administrative expense better. We eventually saw that Chevron actually has a plan, and their plan was to use that general administrative expense to maintain their selling, so they were still able to continue selling, and they invested more in selling, and that is why their inventory turnover ratio did not drop during the period. And we see that we are making decisions, and at the end of the day, Chevron appears to be 18% efficient and blah blah blah. Above all, Shell management may need to think about a reasonable investment in its SG&A in the coming year. Recommendation. You have to make recommendations. I mean, let me look at the end. What did we see at the end? We did EPS, we did leverage, I did a number of them. Then earnings per share. Shell's earnings per share, EPS in 2020 fell by 241% from 1.97 in 2019 to 2.7 in 2020. While ordinary shareholders gained 1.97% dollar in 2019, the impact of the pandemic operation made them lose. Although Shell's performance declined in 2020, when compared to Chevron, it appears that Shell managed and protected the interest of its ordinary shareholder better than Chevron, as Chevron EPS dropped significantly by 291% from 1.55 in 2019 to a negative EPS of $3 in 2020. Furthermore, the overall performance of both companies' EPS revealed that Shell outperformed Chevron in both years. So if you want to invest now, my people, which company are we going to invest in? Based on everything we have said, you can talk. Which company are we investing in?
Sure, I guess.
Yeah.
Sure.
Don't guess now. The number speaks for itself.
Sure, it is.
Yes,
Sure.
the number speaks for itself. It is clear. Even though on a line-by-line basis, and that is why ratio analysis is very important when you are doing financial statement analysis. Because if you are just using trend on a line-by-line basis, you are just using trend. You'll be thinking, if you are looking at revenue, you think that Chevron better Shell. But at the end of the day, if you deep dive, if you go into the nitty-gritty of your financial
Shell.
ratios, you can easily tell that Shell actually did better than Chevron. So in both years, two things we have been able to do here. We have been able to look at trend analysis, and we're also able to do benchmarking. We compare both of them. I mean, thank you very much, guys. I hope some of us will be able to pick up Shell's and Chevron's financials and be able to analyze them, make an attempt, analyze them, post them on LinkedIn, try your skills, teach people so that you don't forget about this class, and then you are also able to, make significant contribution in your respective organization. I mean, I'm very much open on LinkedIn. Pause me. I hope I have the time to be able to, have conversations about some of these things. At this point, any question before we call it an evening? CFO Africa, thank you very much. Question: how many minutes? Maybe how many minutes do we have to even take questions now? Because time has gone. Please, if you have
question quickly.
Yes, maybe two max. They said, can we get the record? It's the record that everybody wants to get.
I don't know how many people even look at the record, but we'll share it.
No problem. I mean, do we have any questions, comments? Have we covered all our expectations? I believe I've covered a number of them, but let me ask us, how was it? Did it meet your expectations? What were you expecting? What did you see from the class? And yes, Lillian, please.
Okay, so thank you very much, Mr. Kudus. Your session was quite insightful. So, well, I know because of time, we are not able to do a lot of things, right? So I was hoping that by the end of our class, right, I would get insight on how to identify financial fraud.
Oh, financial fraud.
Yeah, like if I should analyze a company's three statements, like if I should look at the three statements, okay, I should see that these people are performing a kind of financial engineering in this place or something like that.
I think I've mentioned that. Who wants to help me? I've mentioned that.
Okay.
I mean, I did not mention fraud, but I've taught us how to know that. Who wants to try? Who wants to help me?
Can I come in? I think at the point of gross profit margin.
One. Chinedu.
I think you mentioned that when you spoke about direct costs and the gross profit margin. I mean the discussions you were having with I think Mr. Babatunde, right? I don't know if I got his name. So I think both of you really elaborated on how companies can actually perform such actions.
Okay. Looking at trends, Henry, thanks a lot for that, Henry. Thanks very much. Looking at trends, you look at trends, you'll be able to tell a lot of things. Just mere looking at trends, you'll be able to tell whether a company is performing fraud or not. But let me also mention another thing that you can tell you that a company is performing fraud or not. A company is into subscription business and they don't have contract liability. That means that there will be probably some sort of financial engineering, or don't let me use financial engineering, window dressing in the whole thing. Or, for example, you are looking at the trend. Payable was 900 million, and all of a sudden, from 900 million, it becomes 20 million. There is most likely a fraud happening. You know that people can use payable to take money out of the business. Payable that is not existing. They already have included it in the thing. A service that nobody enjoyed, they will have posted it as part of the company's payable, so that in the future they will take out the money. That's also a way. So when you look at the trend of the payable and you see the way the payable is doing, all of a sudden there is a strange movement in the money. Also, a company is running a business, revenue is 100 million, receivable is 89 million. What kind of business is down? Revenue 100 million, receivable 89 million. You should know that something is fishy. Or a company that is a manufacturing company has no assets. What are you using to manufacture your products? You know, those are the things that you are looking at. You are looking at the interconnectedness of the numbers. I mean, I may not be able to tell us everything here because there are so many diverse ways at which some of these things can come up. But some of the ways and manners, you know, GL proofing is one. Do GL proofing. You will know. From mere looking at the GL, you'll be able to tell whether something is wrong or not. You'll be able to spot mistakes. And some things that we say they are mistakes, they are not necessarily mistakes. Some of them are deliberate fraud. So I hope that answers your question. Thank you.
Yes, thank you so much. Thank you so much.
Okay, good evening, everyone. I hope you can hear me first.
Yes, we can hear you.
Okay, so I wanted to ask first of all about the looking at the trend. What if the company has been doing like small over the years, like a little by little? And also, I wanted to ask him, that's one. Two, if a company uses, like, maybe they are saying we made a profit of this amount this year, but the profit was enlarged by the forex situation in their country, maybe like Nigeria, with the way dollar has been fluctuating over the years. And so they say we made this amount of money, like maybe 500 million naira profit, but it was largely as a result of that forex fluctuation or increase in forex dollar to naira. Can that also be classified as a type of fraud or a type of, like, just
It's not
dressing,
fraud.
window dressing?
It's not fraud, it's not window dressing. If it happens, it happens. I mean, some companies will benefit a lot from the ongoing what's it called? Ongoing currency crisis. If they have foreign balances, if they have cash in foreign balances, right? So they have to convert them and all of those things. So there will be exchange gain for them. It's not fraud if there are supporting documents and it is visible that you can trace this stuff. It is not fraud. That's not fraud. And to the first question where you say if a company is doing it small, can you hear me?
Yes, I can hear you.
So the first question when you say if a company is doing it small, I mean the support documents will tell. So if they are doing it small, at least one time they want to cash out. So that time that they want to cash out, that's when you will know that something will stop. Do you get? I mean, you cannot be stealing just 100K now. If you steal 100K for 6 months, before you know it, you feel like 100K is too much. You want to steal 1 million. And that's when you know that you're actually, something is stopping. And for that purpose, that's the reason why controls are very, very important. We don't joke with controls. Reconciliation, authorizations, approvals, and all of these things. We don't joke with them. Who post what into the system? Segregation of duties, and all of those things. I hope that answers your question.
And just one more thing, sorry. But what if the company that does not make it clear that this is, and if it's as a result of the forex fluctuation, and you just say, oh, made this amount, and then people are jumping in to buy their stocks, that still does not make it fraud.
I mean, if they don't make it clear, that's now communication problem now. If the financials is not issue. Why should we be worried? That's now complete lying. They are lying. And I mean, if they are lying, you can say it in terms of semantics, English is fraud to the public. But if the financials is not saying that what you are saying, it's not the financials that they are using to communicate and lie to people now. It is if they now put, when we now say it's fraud, is if they now put that foreign exchange gain, they now put it in revenue. We now say, stop, you're about to steal. You're about to commit a serious blunder, and that is a fraud. So when they put that foreign exchange gain in revenue, and they are not into forex themselves, that's when we say that is a fraud. But if they don't say do that, then there is no fraud. I hope that answers your question. If you are trying to make them do fraud by fire by force, please don't ask any question again. Thank you. Please let me, Mr. Watunde, you have something to say.
No, actually, well, I just want to contribute to what you are saying
Please go
because I
ahead.
know that they are very, very important. I think your people are very interested in fraud. I don't know, but what I want to tell them is this. Let me tell you, you cannot just know how to detect fraud in a day. Your
Hello,
experience,
sir.
the
I
way
have
you are
something to say,
going,
sir, before you call it off, sir.
Okay, Adebola, please mute your mic. Please go ahead, Mr. Watunde.
yeah.
Your
What I'm
experience.
trying to tell them is that your experience will determine how you can get what is happening in the office. And then sometimes all this now you are calling fraud. By the time you call your management to it, you will see that management will tell you what they want. You understand me? So because I just want to tell them that they need to be very, very, because management
Objective.
determines a lot of things.
You have to be objective.
Yeah. Eh. So no, because what we are discussing here, you need to let them know that what we are discussing here, we are discussing it according to
The standard.
academics and all this. So, but what is happening in industry, in the company that you are working with, because you know that the responsibility of account of a company is the responsibility of the management, even not you.
Mm-hmm. Yeah.
So, what you can call a fraud might not be a fraud. You understand me? I said financial engineering that time does not mean that financial
Yeah,
engineering everything is a fraud. No, you
I get it.
understand me?
Yeah.
uh
I think it
So
is very
please,
necessary. Thank you very
so
much, sir.
please, they should
Yeah.
know that, please. Thank
I
you.
think it is very necessary what you have pointed out, because I mean, at the end of the day, by the time you get to the industry, management will be the one to decide a number of things. But where professionalism also comes in is where you are able to separate what is fraud to what is just leveraging the options that are available on ways to do things. Imagine that somebody knows just straight line method and then see somebody else doing revaluation method and say they are committing fraud. You know, that's not cool enough, because that shows how serious the knowledge gap in the person is. So it also tells us to learn more and wide. And that's why when he said they are doing all of these things, I said, see, yes, is it following standard? If it's following standard, fine. But I still ask questions for that. What kind of business are you into? Product and service. Okay, product and service. Then if you want to now probe further, there are still further questions that you have to ask. Until you have get clarity to those questions, you should not make decision and say, if you make decisions too premature, or if you make premature decisions, it just shows on your own level of professionalism too that you are not yet there. The senior executives, they know how some of these things play. They know how to manage tax, how to leverage some of these things. So for you to be playing at that level as well, beyond academics and beyond what you are listening to in some short, I mean, this is just a 4-hour session that we have done. Max, maybe with this extra time we are using, 4 hours, 30 minutes class that we have done. You can't use it and say you are now a master in fraud detection, or you are now a complete financial analyst. You still have to do a lot more to someone like myself. I've invested a lot into some of these things as well, to be able to even handle this kind of presentation at this level, you know, and to be able to relate with senior executives on different subject matters around finance and accounting and stuff, and still be able to balance, oh, this is what the standard is saying, and if the company is saying this, this is what is possible. And there are times where we also need to draw the line as professionals. But when the time comes, you will know that this is the time to actually draw the line. I mean, somebody is forcing you, management is forcing you, they are not into FX, they are not into anything, and you are the one that will sign the financials. They are now telling you should put FS gain as revenue so that the revenue numbers will go up. You know that cannot fly. But if they are saying you should put it as part of their income as a management accounting mechanism, you know that one will fly. If they say you should add cost of salary of sales agent to cost of sales, you know that one will fly if you are using it for management accounting purposes. But if you are using it for financial reporting, you know it will not fly, depending on whether or not it is commission based or it is salary based. So all of these things we need to know. Thank you very much for that wonderful observation, Mr. Babatunde. Oluwatosin and then Moses Archer. Let's have it from you guys. I think Chinedu also wanted to say something. Guys, we need to call it a day. Please. Okay.
Hello.
Please go ahead.
Including me too.
Hello, Iwelabi, sir. Good evening, sir. Can you hear me, sir?